Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 304th VideoCast podcast for the week ending August 14th, 2025. We got a lot of incredible stuff to cover today. A very special guest interview with the CEO of one of our larger holdings and a lot more. But as always, family first. Got to take the girls to the Orange County Fair out here in California. Had a blast. Then we got, they set up a lemonade stand. Mimi and Annabelle did, and their friend joined them to help Grace. And they sold a lot more. You know, the big seller was this soda called Poppy. They were very creative, very successful, and she's been doing that actually and making some bank. I mean, she's got some triple-digit days in the last week while they're kind of off from swimming and before vacation, etc. So there's another great picture of Mimi and Annabelle. Same thing here, us on the high thing. And I hit my goal inside of 4 years with 3 months to spare. Earlier this week, I hit a 9.8 index. So the two goals inside of 4 years, break 80 once, get to a single digit index, accomplished, only to be taken away 2 days later up to a 10.1. But mission accomplished, and now I can look out 2 years for the next goal, because that's the key thing, is set the next, not for what you get, but for who you become to get it done. So my goal is down to a 7 inside of the next 24 months. And I think that'll probably top out my maximum capacity and a little bit of luck to get there. But that's where it is. So I wanted to share that for those of you who've been following along, only been playing 3.7 something years. December will be 4 years. So that, took a lot of effort to get there, and I really enjoy it. So that's that. Back up to 10-1. All right. Without further adu, we had the most incredible interview, highest viewed interview of all time for 5+ years. We've been doing hedgefundtips.com with the CEO of VF Corp. That's Vans, Timberland, North Face, Dickies, Alta, Icebreaker, and more. You got to listen in here, and I'll tell you what, as great as Cooper Standard has been, went from whatever 5 and change from our initial basis to now knocking on the door to $30 and probably going to double again here in a reasonable amount of time. In our view, all of this, by the way, is opinion, not advice. Go to hedgefundtips.com and click on terms, talk to your financial advisor, don't do anything until you talk to someone else, and blah, blah, blah. So that's that. I think VF is going to be the next Cooper Standard. And this interview gave me a lot more confidence in that outlook. So we're going to listen in here. Well, without further ado, I would like to welcome, and I'm truly honored to welcome, the president and CEO of VF Corp, Mr. Bracken Darrell. Thank you so much for joining us today.
Thank you, Tom. Thank you very much for having me. Well, I like the announcement. I feel like the Chicago Bulls opening when Michael Jordan was there.
Company very well. VF Corp has major, incredible brands: Vans, North Face, Timberland, Dickies, and a lot more. Mr. Darrell will speak with us about that. But I do know that you're on a timeline, so I want to get right down to some of the questions and give our investors as much valuable information as we can. We've heard your quarterly earnings call. Congratulations on a great quarter, by the way. The turnaround is going along exactly as you promised when you took the helm just a couple short years ago. One of the core things, I'm going to start with compensation, and most management would say, uh-oh, here we go, but it's just the opposite. We're really excited about how VF Corp has set this up, and one of the core things we look for in potential investments is the overall alignment of management with shareholders. Are they acting like owners, and do they respect shareholder equity? Since joining VF Corp in 2023, you have personally written over $3 million worth of checks from your own pocket to purchase stock, and several other board members and executives have made material open market buys. You have a policy requiring significant share ownership over a 5-year period, ranging from 2x to 6x current annual base salary, with credit given only for direct holdings. On top of that, 90% of your compensation is tied to financial targets, including revenue, operating income, gross margins, with 50% of stock option awards linked to long-term performance goals. The rest of the executive team has similar performance-based compensation. Can you speak to how you and the board think about alignment with shareholders and why you believe this culture is so important for the VF Corp turnaround?
I don't know if most people are as financially motivated as a lot of investors might think, but certainly some people are. But in my experience, good boards and good leaders understand that the scorecard for winning is about increasing shareholder value dramatically. And so whether they're there because they want to make a ton of money or they're there because they want to be viewed as a big winner, both of those arrive at the same place, which is you should absolutely have the performance tied to the performance of the stock. And so and the performance of stock is usually a direct reflection of the growth of the top line and the growth of the bottom line. So I couldn't feel any more strongly that, especially the CEOs, but also, the rest of the management team should be very directly tied to that. And we are. And I think every company really ought to be.
Yeah, I agree. And I'm really happy to hear you say that. When I got involved in the stock, pre kind of tariff fears, I was just sharing with your colleagues that we've got a pretty low basis, $13 and change across the board. And we saw you start to implement the turnaround plan, and the stock ran up from 13 to 28, and then there were some fears about tariffs, and it got knocked down. But when I originally wrote this, and I wrote a personal check, and I wrote big checks for my clients to buy stock, my basis, and by the way, my nickname on Wall Street is Turnaround Tom. So we do have something in common, as you're a turnaround specialist as well. I had originally underwrote this. I said, look, the number one thing with the turnaround is take solvency risk off the table. So I underwrite for that first. If they do that, you get a double. If they actually stabilize the business, you get more than that. And if they execute and grow and turn it around, you can get upside. But my initial underwriting was, $40, $50 stock. Okay. And as I've listened to you over the quarters and seen what you said you were going to do and see what you've done, leaving aside the short-term liberation noise and all that stuff that you're going to work through just fine, I've taken my internal underwriting up from that 40-50, because you've already taken solvency risk off the table. You're already stabilizing and growing most of the brands. I think I can't tell you if it's going to be 3, 4, 5, 6 years, but generally 3 to 5 years, I think this stock could work its way back to new highs. And I know you can't guide on any of that. Little bit of curveball here. When you forget about the guidance, forget about it. You're an individual investor. You wrote $3 million worth of your own money into stock. Did you have a similar view to me, or do you think I'm too optimistic?
Well, since I can't talk about, I could, but it'd be naive of me to go out and start predicting stock prices like that.
Yeah, fair point.
I can't really respond directly to that comment to your question, Tom, but I'll talk about why did I invest.
Yeah.
I invested for a couple of reasons. First, I think, I wouldn't be here. First of all, you deserve the name Turnaround Tom because you've invested in turnarounds serially and they've worked. I don't think I deserve the name. I'm not Turnaround Bracken because I really never go into any of these with that first objective, that double objective. That is not my objective. Yeah. In fact, I just view that as like if you're on a stairway, the turnaround part of it is the first 2 or 3 steps. That's just a path. That's just part of the pathway to what I really want to do. I love creating long-term growth businesses. I mean, that's my game. Yeah. That's all I'm here for. That's all I ever cared about in my life from a career standpoint. I love to grow people. I love to grow businesses. I love to grow brands. I love to create great things, great products. So that's why I came here. It wasn't to do the turnaround. The turnaround's just a step along the way. So that's I guess my starting point. My second one is in terms of the investment itself. I would say as a result, I think we're a tremendous investment, or I wouldn't put my own money in.
Love it.
Also wouldn't be here if I didn't feel that way. So I feel like it's a tremendous investment. As you said, we're trading at kind of not historic lows, but at pretty low prices relative to even 4 or 5 years ago.
Yeah.
And the brands are fantastic. I mean, we really have tremendous brands. So that's about all you need. The rest is really leadership, getting the right team in place, and then putting the process in place and executing. And I think I can know how to do that. The most important one is getting the right people here. And we definitely have, at least at the top now, I've really got a fantastic team.
Right. We're going to get to that here. Something we always prioritize at Great Hill Capital is investing in companies with high quality sound management, what we call betting on the jockey. And that's exactly how we view VF Corp, because by all means, Bracken, you're a turnaround specialist, whether you want to call yourself that or not. Turnaround Darrell, let's leave that aside. We're going to call you growth company Darrell. But for those in the audience who may be less familiar, Bracken's first major turnaround was Old Spice, where he tripled market share in 2 years, creating one of the most successful turnarounds in P&G history. Then he took over Logitech in 2013 when the stock was down 82%, sales were declining, operating margins had collapsed. Over the next 8 years, the stock went from $5 to $133, delivering a 26-bagger. The setup sounds very familiar to what you faced when you joined VF Corp, a stock that had fallen 85% with declining sales and operating margins cut in half. Could you first discuss what you've learned from your track record of successful turnarounds, and now that you're approaching the 2-year mark at VF Corp, compare and contrast your plan, execution, results, and results to date, and expected outcome between Logitech and VF Corp to date, Logitech being a 26x because of you. Maybe kind of draw some comparisons if you see any.
Well, the most important, what have I learned today? What have I learned in my experience? The most important thing is great. If I've learned anything, and I've been very lucky to work around great people, and I had great people at Logitech, and I built that team over probably 5 or 6 years, to really get it to where it was. The team that really had that kind of performance. It didn't take 5 or 6 years to perform, but it took 5 or 6 years to get there. And it probably didn't need to take as long as it did, but that's just intuitively how I felt like the timing that made sense. Here, I've gone much faster on the people side. I'd say it's taken me, really a year and a half to get to the same kind of caliber team. And that super team is still over there at Logitech, and I've got a super team here now. So I feel really, really good about that. So those two things are very parallel in terms of what we've done so far. The second thing is it ends up being all about if you think about it, the requirement to be financially disciplined aside. So we'll park that for a second because that's a given. If you think about it, we only do two things. We create products that ideally make people feel better about themselves and are preferred to other people's products. And we create, and we help build brands that people want to join, want to be part of. And those are the two things we have to do exceptionally well. And so to do that, you've got to have a great product machine. So one of the first things we really worked on here is first of all, and we didn't have this problem, Logitech, let's get to one product process. It's as if we had, 13 different factories or 32 different factories for creating products. They were all doing it differently. We've gone to one now. Now that's still not fully implemented because it takes a little while to cross over and get to that common practice. But it's a best practice. It's a best industry practice. And so by the time we get to, over the next 6 to 12 months, we'll be on that one common best in class process of ideating and creating product and bringing it to market. That's the most important step from a process standpoint you can do in this company. And I feel super good about that. Now, we're going to do that for every major process in this company. We are. So think about that like you open your phone and you've got apps on the phone. Once you've got one really good process, it's like an app. And so every time there's an improvement to that process, you can update all the different brands, apps, or processes at the same time.
Wow.
So that's where we're headed. And that's really going to be a good best practice. I dreamed of doing this before when I was back at P&G a long time ago. And P&G generally had one good, strong process.
Yeah.
Ever since I experienced that, I wanted that in every company I was in. Logitech, we didn't have that problem because we were on one process. Here we didn't. We weren't. So we've done that. So that's the second step we've made. So first people, second processes. The third is functional excellence. Is really bringing in people who are the best in class at what they do and making sure that we're constantly pulsing the industry and outside our industry in areas, let's say, for example, AI today, where the best things that are happening, we're bringing them in, learning them, and then becoming functionally excellent in them. Those three things are super, super critical. And we're well downstream on all three of them. I would say all three of those were really critical to the performance of Logitech. The second one was easier to do because we were already on one process. We just had to improve it. And then the first, the people side, the functional excellence side took years to develop, and that's exactly what we're doing here.
Thank you. Well, that's really, really helpful. I want to talk a little bit about the cleanup phase, which you've been going through the last 24 years. Probably the one you hear the most about, and arguably the biggest piece
24
of
months, 24 months.
Yeah, 24
I
months.
think some investors feel like it's 24 years, but it's been 24 months.
24 months, exactly. No, but it's been very, very short time, but a lot accomplished in that short time. But the one you probably hear about most, the piece of the turnaround, biggest piece of the turnaround, and that's Vans. I now have 5 pairs, by the way. I picked up another pair at Vans by Talia in Laguna Beach this weekend with my girls. This is a brand VF acquired back in 2004 that went on to grow 10x over the next 15 years. So, from starting in the early 60s, and yet they were able to drive that growth. But it's been under real pressure since, as you know, revenues in the most recent fiscal year were more than 40% below their peak. In fiscal year 2022, you've been open about what went wrong, that Vans lost touch with its core audience by chasing trends, became overexposed to value channels, which diluted the brand and leaned too heavily on legacy franchisees. Since you stepped in back in 2023, the focus has been on taking your medicine and cleaning things up, from existing value channels and closing unprofitable stores to right-sizing inventories, all of which have helped to drive significant gross margin improvement. Could you speak to that initial phase of the Vans turnaround, what you prioritized, what you think needed fixing most urgently, and how you've approached setting the brand up for a comeback?
Yeah, I think this happens a lot in very successful businesses. That the thing, it's like the thing that gets you there, you overdo it. It's like you get a really, really strong muscle, and then you just keep going and going and going. And then suddenly one day you're so overdeveloped that the rest of your body's in trouble.
Yeah.
And that's exactly what happened here. And I think they did some really great things with the brand. I mean, the Warped Tour, just fantastic. They had fantastic products that were really appealing, and they did really good things with them. And then they just, again, it's so easy to be 20/20 hindsight. I'm not critical of anybody who was here at the time because, before the grace of God, it could have been me.
Yeah.
But I think they had a few things that were really working, and rather than keep that innovation funnel filled where you're constantly putting in new ideas, innovation ideas on the product, innovation ideas in marketing. They had things that were working, and they just poured more and more fuel into those. And they took them broader and broader in distribution, for example, into deeper into the value channel. And they just went deeper and deeper and deeper and broader and broader and broader on some of the same styles. And there wasn't something behind them.
Yeah.
It's just they had cut the spending, or at least they hadn't increased spending on the innovation pipeline. And the problem is at some point that music stops. So that's really what it was. And if that sounds overly simplistic, I don't think it is. The cool thing is the brand is as strong as ever. It's a fantastic brand. You really have a very hard time finding anybody who doesn't think the brand is really strong.
Yeah.
That's a great sign. That's like a wonderful sign. And the business is in trouble, but the brand consumers don't seem to realize that, well, why is the business in trouble? The brand's good. I just don't see anything I want to buy right now. That's a good sign if you like to create products, because it means we can come back. And then the marketing side of it is just getting people, trying to find your way into the cultural excitement that's happening in the moment. Trying to lean into that. I'm not a big believer that you can create big, broad trends usually as a company. Sometimes I think people, maybe they pull that off, but you can usually find them and then align your brand with them and then do things that consumers see as really fitting the moment. And so that's really what we're up to now. And it's super exciting and fun.
Yeah, that's great. Well, thanks for commenting on that and the cleanup. I want to talk a little bit about growth. The focus seems to be on creating new products and returning the brand to its roots in many ways. It reminds us a little bit of what New Balance pulled off in recent years, maybe Converse to a lesser extent. After 15 years of sale declines, they reinvented themselves, New Balance that is, by leaning into streetwear culture, influencer partnerships, and high-profile collaborations. In terms of returning the brand to its roots, it doesn't get much clearer than bringing back the Vans Warped Tour. You sold out 3 events in a matter of hours and drew nearly 170,000 attendees in Long Beach, more than double the previous peak. You've also introduced new core franchises like the New School. Now you're #2 global franchise and top growth driver, along with sellouts like Super Low Pro. I have a pair, by the way. I think I sent you a picture. And continue to successfully lean into the premium product space. On top of that, you've rolled out several high-profile collaborations, including Lil Uzi partnership, and continue to elevate the marketing approach. As we head into back to school and holiday seasons, what should investors expect to see from Vans as this brand work starts to materialize? Are there any early signs of traction you can point to? And how should we think about the early influence of Sun Cho as she begins shaping the brand's direction going forward?
Yeah, first of all, Tom, you've made the same mistake I did. It's Sun Che.
Sun Che, excuse me.
When I introduced Sun, she corrected me. I introduced her to whatever thousands of employees at Vans, and she said, Bracken, I hope you realize it's. I think she said Darrell. I think my name is Sun Che, and I said, oh no, I appreciate that. My name's actually Bracken Darrell, not Darrell Bracken. So, we still laugh about that. I think the New Balance example is fascinating. I think it's one of the most successful growth stories I've ever heard of. And I grew up with New Balance. I'm old enough to remember when New Balance was just a running shoe. And what they call the dad shoe today was never a shoe I actually ran in, but I remember the brand, and it was a very narrowly targeted running shoe. And they stayed that way for a very, very long time. And I knew the prior CEO quite well, and he left to run Purple, I think, and the new CEO took over, and it seemed like just miraculously it took off. And so I studied that one with my team because we found it just a fascinating example. But there are a lot of examples. The cool thing about this industry, there are good examples of brands either getting their mojo back or getting mojo back and a lot more, like the New Balance story, or creating mojo, like On, or creating mojo after quite a long time, like Hoka. It's a cool industry where when you start to get things right, things really can take off. And so it's another thing I love about this industry is people are interested in enough that can happen, and we all spend enough marketing to help make that happen. So I can't comment directly on back to school, but you asked for early signs. I mentioned this in our earnings call. We started here really trying to move things just like we did at Timberland at the really kind of the top of the curve. So at Timberland, I'll use as a parallel. When I first got here, we started doing these. It was the 60th anniversary of the boot, and we started doing collaborations with some of the best, hot designers, not people you never necessarily heard of, but they're really known in the design community or the fashion community. So we did 8, I think, of those in a row. We kind of month after month, we put them out there. It was our birthday, it was hip hop's birthday, it was the hip hop, it was the boot's birthday. We did a little movie that very few people saw. It was one of the coolest movies on the planet. So we did a few things there, and that was really intended to kind of seed the very top of the industry. And then, thank God for Pharrell and Louis Vuitton, and they reached out to us and said, "Hey, we'd really like to do something with you guys." And that created the next wave in Paris. And then Maisie Willoughby, who's our brilliant CMO, working with Nina Flood, who's our brilliant president. Nina had this idea, hey, what if we bought out all the billboards and put Je instead of Je t'aime? If you don't speak French, Je t'aime is I love you. Je t'aime is I love Tim's, I guess. It'd be kind of the equivalent. So we bought all the billboards in Paris, all at the attempt to try to get, our mojo back.
Yeah.
And it worked, and then Timberland started to come up again. A lot of we're doing the same thing in Vans, where we started with a sub brand called OTW, stands for
Yeah.
Off the Wall. We brought cool collaborations. They all sell out immediately. And so we've been doing that now for a year and a half. And the cool thing is now in Paris this year at Fashion Week, where a lot of the industry comes together, we had the tier zero, the top of the industry, people who want to carry our OTW product. We were up 50% in booking, 50% in meetings there, and we had people that had not carried us in years who came back and want to carry it now. So it's
Wow.
just a good sign. It's like I mentioned in the earnings call. It's a good sign that things are happening. Now that is a sliver of our business. It's not going to have any meaningful impact in absolute dollars volume of profit on the Vans brand if we sell 3 times more of those. But
Right.
the fact that they're interested. Trends start at the top. They don't usually start at the bottom. So it's going to flow down, we believe. We'll see. We'll have to prove that.
That's great. That's great. Well, thank you for that color. Looking now, I want to go into the reinvention. Looking back when you first joined VF, you threw in the kitchen sink quarter and took all your medicine at once, resetting expectations, cutting the dividend. You launched Project Reinvent, which focused on 4 priorities: delivering $300 million of fixed cost savings, strengthening the balance sheet, creating America's regional platform modeled after the successful EMEA and APAC operating models, and driving sustainable growth through Vans turnaround. Now, nearly 2 years in, you've delivered more than $300 million in cost savings earlier than originally expected, deleveraged the balance sheet by selling Supreme for $1.5 billion and reducing the debt by over $2 billion, and are on track to reach 2.5 times leverage by fiscal 2028. You've successfully implemented the Americas regional model, and 2 of your 4 largest brands have now returned to growth. You've emphasized having a high say-do ratio since day one. Could you speak to your experience leading this turnaround over the past 2 years and walk us through the key stages, starting with cleaning up and resetting the table, and now what investors should expect as the focus shifts to returning VF back into a growth company? I'm going to call you now Growth Darrell.
Good. I think one of the key things that happens to companies when they get in trouble is they get really good at growing, the top line for a long time. And as a result, they also get good at growing their SG&A for a long time. And then when they stop growing or they start to decline, they continue to be good at growing the SG&A. So it gets out of whack.
Yeah.
And nobody is as flexible as they want to be in adjusting SG&A to the top line. So taking out, $300 million of SG&A was just a must, and it was the same thing at Logitech. I was there. So and by the way, it was the same way at Old Spice long ago, my first turnaround to growth. So that was like job one. But then, then you get back to a lot of things I already talked about, which is, once you get your cost in line, you get it, if there's maybe the most important number in any P&L, in my opinion, and you're a financial expert, I'm just a guy who works in businesses, but I think the most important number in a P&L is the gross margin, because everything's captured in that. It's like looking at DNA, If your DNA is healthy, then and interesting and suggests you're going to have a strong, high level performance in health and longevity, that's a very good sign. And I think gross margin is the DNA of a company. It shows you how strong your brand is. It shows you how strong your products are. It shows you how strong your pricing power is. There's a lot in that. So I am very fixated, admittedly, on gross margin. So we worked hard to figure out how do we get our gross margins back to where they need to be, and we have specific targets we're after. We've been pretty public about those. And when we hit those targets, we'll be at 55%, 45%, 45% SG&A, and we'll be at 10% operating income. That was with no growth from where we were then. So I believe we're really well on track to doing that, and that's connected to that 2.5 times leverage that we're planning for 28 or below. And so all of this is like on a very logical path to get to the point where the real starting line is, which is it's all about growth. It's all about growth. It's always all about growth once you get the fundamentals right from an SG&A standpoint. and a basic cost standpoint. So today we are all about growth.
Yeah. I love it. I love it. And you did lay that out in Reinvent to Growth, 2 medium-term fiscal year 2028 targets, reaching 55% gross margins and more than doubling operating margins to 10%. What stood out to us in these targets is that they're entirely based on cost savings and assume zero revenue growth. If our math is right, even under that highly conservative scenario, this business would earn close to $2 a share from the margin expansion and cost savings alone, which in our view would support a stock price more than double current levels. Obviously, don't comment on that. You've also noted that each additional $1 billion of revenue or 10% growth could drive an extra 1.5% to 2% of operating margin improvement. That becomes especially relevant given the 3 to 5% growth outlook for the broader apparel and footwear market over the next few years, alongside VF's own category expansion, whether it's North Face aiming to 2x apparel and equipment and 3x footwear, or just taking market share with stronger product and brand execution. So between a growing market, category expansion, and share gains, it's hard to see a scenario where VF doesn't participate in the growth. My question is twofold. First, is that a fair way to think about the earnings power and upside from your medium-term targets? And you can be as vague as you want. And two, are those fiscal year 2028 targets still firmly on track? How are you thinking about progress so far? And given that the targets are primarily driven by cost savings, how are you approaching tariffs and potential mitigation strategies, especially considering 85% of the U.S. volume is sourced from Southeast Asia and Central and South America?
First, yes, we're still on target to those
Love it.
goals we're on track for those goals as we said here in the earnings call. The tariffs are obviously not something anybody planned for. We certainly didn't contemplate them when we came to those targets, but we continue to feel like we can manage within our current game plan to deliver those targets, even with the tariffs. If I wouldn't be able to say that with any confidence if the targets affected us disproportionately to others in the industry, but it's sure, based on all that we can see, everybody's kind of affected equally. So this is kind of like a big macroeconomic reality that we're all dealing with. So that means people are going to manage it just like we are. As much cost as you can get, price increases for you on top of that. And in the end, that will all adjust. We'll have a short-term impact that'll last us whatever it is, a year, 18 months or something, until it's all, the divot that the tariffs immediately give you can't offset immediately. But we'll end up offsetting all that. So that's really what we believe. And we said that during the earnings call, and we're all in to go make sure that happens. In terms of the responsiveness of this business to growth, one of the coolest things about this business in particular is it has so much leverage. It's incredibly painful on the downside when you lose revenue, and incredibly wonderful on the upside when you add revenue. So that's why you could add $1 billion of growth to this business and get 1.5 to 2 points of operating income expansion if you want to put it into that, because it's there. So it's a cool business from that regard, but that does make it, that plus the fact that we have debt at the level we do makes it quite a volatile play going down and up. So it'll be interesting to see what happens as we start to grow at some point.
Great. Couple more here as we wind down. I know you're on a timeline as well. I want a couple final on leadership. A players tend to follow other A players, and since you took the helm of VF Corp, the company seems to have become a magnet for talent. In fact, including you, 12 of the 16 leaders on the global leadership team are either new to the company or in a new role. That includes Sun, who's now global brand president of Vans, who joined from Lululemon after nearly 7 years as chief product officer during a period which revenues quadrupled. And the brand became one of the most respected in the apparel space. Or Chris Gobble, the new brand president of Dickies, who came over from Gap after helping lead its turnaround. The list goes on, but what's clear is you've built what looks like an all-star leadership team. That said, could you speak to what this new group brings to the table that may have been missing before, the kind of culture you've worked to build, and the difference you've seen as this leadership team starts to show its impact?
Yeah, I think they came for a couple of reasons. As you said, A players tend to be more likely to hire A players, but I think the more important factor is great brands with great potential tend to attract people who love great brands. And I think
Yeah.
that's the bigger driver. I'd love to give me and Brent Hyder, who's our head of people and the head of North America, of the Americas too. I'd love to give us both a pat on the back, and I'll give him one because he does amazing things. But I think it's just as much the fact that we've got such amazing opportunity here, and people smell that and they love it, and that is super super exciting. In terms of the team itself, I think this what I really believe is that great teams are made of people who feel super excited about what they're doing. They feel the potential. They feel enabled by the company more than hindered by it. Since I've spent my whole life in relatively large companies, I have an incredible, maybe because I have an incredible bias against bureaucracy. I hate bureaucracy. I hate long meetings. I hate big decks. I hate all that stuff. So I really do all I can to try to create this little, um, uh, I'm trying to think of a better word, but quicksand of big company reality as possible. The least amount of process, but good process. That process I talked about earlier, we were 32 to 1. Well, the goal is not to have one really thick process. It's to have one thin, clean, streamlined process. It's but the least process is the best process. Not too little, because you need good process. I would love that, but I think the error that most big companies end up with is they keep it. It's like you end up after a while you end up like a hospital that's been there for 30 years. Somebody gave the heart wing and somebody else gave the dermatology wing, and where it's like 10 different buildings all kind of stuffed together. And I've worked in enough big companies to have felt that myself, and I'm doing everything I can to avoid that. I want this to feel like a pristine, brand new building that you walk in and feel transparency and flexibility and empowered and fast.
That's great. A little bit on touching on North Face here before we go, switching gears to a brand firing on all cylinders with a whole lot more ahead of it. North Face has become the largest outdoor brand in the world. You recently laid out plans to make the North Face a true four-season brand, aiming to 2x the apparel business, 2x bags and equipment, 3x footwear, implying a 7.7 billion revenue run rate down the road. You're also coming off the Skims collaboration with Kim Kardashian, which became the fastest selling partnership in brand history, selling out within hours and generating over 10 billion impressions. Could you speak to the current health of the North Face brand, where you see the biggest opportunities for expansion, and how you plan to lean into maybe influencer-based marketing and perhaps future collaborations to drive continued brand heat?
Yeah, I'll speak for Caroline Brown here, who came in as a luxury brand expert and really came into the North Face, but she's also an athlete herself and loves the performance orientation of this brand. I think the magic of the North Face brand sits in those two extremes. On the one end, you've got this brand that started as an equipment brand and is probably the most present brand in the climbing of Everest, or maybe all the other really challenging climbs you can think of. We have over 200 North Face athletes, including Alex Honnold, who did free solo and climbed that incredibly scary climb with no ropes live in a documentary. And if you haven't seen it, please do. Yeah. On the other end of the spectrum, you've got people who love to wear North Face in New York, in the winter, in a subway, yeah. and it's fashion for them, and it could be better. We're not doing anything in the North Face as well as we could. And Caroline would be the first one to say this, despite the fact that the business is so strong and the is strong. There's so much unexploited opportunity in the North Face, whether you're talking about really being a four-season brand, and we can talk more about that if you want to, but really being a four-season brand, or really just exploiting the fact that we can be a much more fashion-aware brand. People love to wear for how it looks, not just how it performs. We're not doing either one of those nearly as well as we could. And so by the way, we're also not doing nearly as well with women as we could be, even though we do sell to a lot of women. It's not that we don't, but there's just opportunities left, right, and center on the North Face from where I sit. And Caroline feels the same way. And I think we've got the right team in place to make that happen.
That's fantastic. Weaker dollar, just want to touch on that before we close up. As a multinational company with 55% of sales outside the US, a strong dollar has been a significant headwind in recent years, with the dollar having its worst start to the year in over 50 years, down nearly 10% year to date. How should investors think about the potential impact if this weakness persists? Could it become a meaningful tailwind going forward?
I'm never too
Yeah.
like everything else that you can't control. I don't spend too much time thinking about it. In the short term, weaker dollar is a little better for us, because obviously it improves our profitability. We do have SG&A that's dollar based, it's this dollar based. We have a lot of SG&A outside of the U.S., so that hurts us. But generally speaking, a weaker dollar is better. But I'm just not going to rely on that. I think it's nice if we have it, take advantage of it. We'll make sure not to get so dependent on it that we can't be flexible and move in the other direction when it swings, because it always does.
Yeah.
So if I've learned one thing, just be on the balls of your feet. Don't rely on anything you can't count on. You can't control yourself.
Love it. Love it. Is there anything we didn't ask Bracken, but you'd really like to share or talk about as we close out?
No, I'm obviously pretty excited about this business, and I didn't come here for 2 years. I didn't come here for 5 years. I came here to turn this into something, and I came here for a decade. Most investors are not here for a decade, so I'm very aware of that. That they need to see results quicker than that. But we're executing, and we're doing what we said we would do. I think we're right on track to what we need to do to be this great company that I believe we can be.
Yeah, well, we're much longer term than your average investor, Bracken. Our holding periods tend to vary between 3 to 5 or more years, and that's what we like to see. And the last question I have to ask is, what's your personal favorite pair of Vans and why? I like my new Curran Capitals. What are you wearing these days?
I am wearing a pair of premium old schools today that we just launched. Yesterday I wore. I wear a different one almost every day, and I can't even tell you how much. If you think I've invested a lot in VF stock, you should see how much I've invested in Vans shoes and all the rest of our stuff. I mean, we just make good stuff.
Yes.
I would say my current favorite is probably a pair of neighborhood collaboration Vans that are just very cool. They're black, and I like it. But honestly, I like so many different products right now. It's hard to choose, and that's a really good place to be. And it's getting harder and harder, which is a good sign.
Yeah, well, that's exciting. I can't thank you enough for taking the time to talk with me and a lot of our investors and many people out there that really want to see the incredible value in this story. I'm now going to call you, my new nickname for you is Growth Bracken, coming to you from the heart from Turnaround Tom. I think we're going to leave it there. Thanks so much for joining.
Thank you, Tom.
And we're back. And then on Friday, I had the pleasure to join the great Ash Webster on Varney & Co. Thanks to Christian Dagger and Peyton Jennings for having me on. We got to talk a little China, which was a curveball. We were supposed to talk about something else, but really glad to do that. We'll listen in here.
I'm Ashley Webster in for Stu Varney today. Let's get straight to your money in the markets, and it's all very positive. The Dow is up 0.5% after losing 200 points yesterday. S&P and NASDAQ also up 0.5% or more. 10-year Treasury yield. Let's take a look at the 10-year, see where that is right now. There you go. It's up 3.3 basis points on the way up. The yield at 4.28. And Bitcoin was down a little bit earlier, down about $372 at 116,970, almost $117,000. All right, Thomas Hayes joins me now. Thomas, good morning to you. In the last hour, we spoke to Kenny Polcari, and he thinks the market is too dependent on the Magnificent Seven. What say you?
I agree. I think managers are going to be finding their outperformance in buying the laggards, those stocks that have not risen quite as much. I think in terms of animal spirits coming back to this market, we have a dovish pivot at the Fed with the appointment of Stephen Mirren. That's going to be very, very positive. Mm-hmm. We're now showing a 91.4% chance of a cut in September. So there's a lot to like here, but you have to be very selective where you buy in coming months.
I heard someone say earlier, and very quickly get your comments on this, the Chinese economy is coming back thanks to all the government interventions to help that along. Should we start looking at companies with large exposure to China to get ahead of that story?
Well, it's funny you mentioned that. There's no question it's the most untold story happening right now. They've been stimulating for over a year, and you are starting to see a massive reacceleration. We own a company called Alibaba. They're like the Amazon of China. That's our exposure. But certainly you're going to start to see companies like Nike start to benefit from a reacceleration of the Chinese consumer. And the Chinese government has mandated that they want to get consumption to 70% of their economy by 2030. So any company in China that benefits from consumption is going to start to do well in coming years.
You will buy it, says Beijing. They may not have a choice. Tom, thank you very much. Thanks for your time this morning. Let's take a look at the markets again.
And we're back. And then I want to thank Johan Cherian and Sanchiyata Roy for having me in their article on Reuters. You can check that out. And now on to the data. We like to kind of start a little bit with a quote of the week, which is from Peter Thiel this week. The most contrarian thing of all is not actually to oppose the crowd per se, but to think for yourself. Be an independent thinker. Burden yourself with the facts. And that's what we try to do here every single week on Hedge Fund Tips with Tom Hayes. We had some new people send in pictures. A lot of you are getting orders. And the key is not the orders. You know, I think we make $6-7 on a hat, maybe 8, I don't know. But the key is birds of a feather flock together. And I know that the level of sophistication on this podcast, the people listening in and that are big enough fans to buy a hat or a shirt or a hoodie or a mug, hang around with like-minded, successful people. And most of them are very successful business people, and they come to me for investing ideas. And then over time, they make money from the ideas and they wind up hiring me as their manager because they want to keep growing their business or just enjoy life if they sold their business, and so on. So the purpose of this merch is not to make $6 or $7 on a hat. The purpose of the merch is that it helps to grow the listener viewership with like-minded people so that we continue to be incentivized to offer it to both clients, which will always get it, and non-clients as long as possible. And the formula to keep me doing this for non-clients is that we continue to grow. And we have been continuing to grow. And I know many of you are sharing this like crazy, and I want to thank you. And I would say for the newer people, the number one compliment you can pay me, I get a lot of thank yous, super grateful for that, super grateful for the viewership. The number one compliment you can pay me is to share this podcast with one like-minded friend or family member that you care about, that you think would be interested and benefit from this. And wearing a hat sometimes is exactly what opens up that conversation. So we got a bunch of new people. Go here, click on the link that says Number One Hedge Fund Podcast. This new one was from Dan G, sends a picture from Ireland, super excited. And you can see a lot of our others, all different folks from all over the world. And we're super excited if you share that. And a lot of you have been buying it and you don't want to share it. I totally understand privacy. You could either use first name or not even send it. And we appreciate your support. As long as it gets the word out and people ask you, hey, what's that hat all about? And you say, look, I listened to this podcast. I made some money off the ideas, if that's the case. And, you might want to check it out. And if you watch it on YouTube, you get twice the value. If you listen to it on audio while you do your daily walk, you're going to get tremendous value that way as well. With that said, let's get down to data, baby. All right, here we go. First off, I want to start with Slumer this week over at RBC. Thanks to my friends over there. Let's talk about seasonality, ladies and gentlemen. Obviously, we all know the worst seasonality is August, September, October. So if you're not thinking we're going to get a little chop, you're not being realistic. This is the time of year it tends to happen. However, if you look at the compilation of historical trends going back to 1928, there is a tendency for this to stay pretty strong through year end. And that's why I've been kind of in the camp of maybe 3 to 8% pullbacks to be bought to create opportunities. But I think, if you think about the S&P 500, it's basically a Mag 7 index by weighting. So while the overall indices could see that chop, I think you're seeing more and more of the under the surface. And certainly if you're a client, you're seeing it in the P&L. I mean, what an unbelievable week, by the way, even including today's little noise with the PPI. The names, the quote under the surface, which is where we play, are doing extremely, extremely well. So this is less important for us than most. And I think what's going to happen is we're going to wind up harvesting a decent amount of profits pretty early next year, and have higher than normal cash levels as we wait for the normal mid-cycle, midterm election year volatility into late October, and then just reload a ton of cash and ride it into the end of the year. So we'll see. We'll take it time by time. We got to take it on a company by company basis. If the company's not at fully valued, we're not selling it. But I think some of them are going to get there pretty damn quick in the next 6 months. And we are going to be helping a lot of people out when they're clamoring for the stocks that no one wanted at the lows. Everyone's going to want it at the highs. And then we'll just rinse and repeat, sit on a little cash, maybe put on some shorts, and then buy a ton of stuff on sale in the fall of next year and go ahead. So pretty exciting outlook here. And then you've got S&P, little momentum waning. Does it go back and test where it broke out? I don't know. I think still the pain trade feels up, but the PPI numbers this morning, we're going to talk about the PPI numbers, by the way. Advanced decline line. What else we got here? Russell small cap is starting to take off. This is pretty early. Today's a hiccup. I think this is going to persist higher in the even in the near term. I don't even think it pushes out to the intermediate term. You see sentiment kind of middle of the range. What else we got here, Slumer? European looking like it wants to break out of this channel. Hang Seng right up here, testing here. Check back, pushing to new highs. This looks a lot like the Russell, by the way. And if you go back to the let's see, the Mammoth cycle. All right, we'll go back to it. Justin Mammoth sentiment cycle. I think we're right here with BABA, i.e. China. So take a look at this. This looks a lot like right here. We're just getting through denial, a little more chop. We had that aversion that shook everyone out right here. And, whether earnings is going to be the catalyst, whether a meeting with a deal with China is going to be the catalyst. I mean, Tencent earnings were good. JD's earnings were good. I think Alibaba is going to be very good. But I think the China deal that comes in the third quarter here is going to be what's this final parabolic move. I wouldn't say final. I would say beginning of parabolic move higher. And then we'll see what earnings, cash flow acceleration, earnings growth looks like back up here. So these are exciting times. I mean, it's just the time arbitrage game, being patient. Okay, so this morning, wholesale inflation accelerates, the PPI. So you can see it's high relative to going all the way back to 2022. Now, if you listen to the Fed, take with a grain of salt, they have modeled in it's a one-off and then normalization. At BMO Capital Markets, Ian Lingen said there wasn't anything in the details that materially changed investors' understanding of the state of play in either the real economy or the Fed. The 0.9% jump in PPI reflects lingering cost pressures, some driven by tariffs, but core inflation trends remain contained. Let me repeat that. Core inflation trends remain contained, according to Gina Bolvin, president of Bolvin Wealth Management Group. It's a reminder that the path to lower rates might not be linear, but the broader disinflationary trend is still intact, she said. This is not a signal to panic. It's a time to focus on fundamentals, maintain diversification, and look for companies with stronger pricing power and healthy margins. Meantime, Treasury Secretary Scott Bessent said, so he kind of walked back a one-time 150 basis point cut. Blah, blah, blah. I don't tell what the Fed could do, but he did say that we're 150 basis points. I've been saying 200, but he says 150 basis points above neutral. And even after the PPI, the odds of a cut in September dropped from 98%. They're still 90%. So there's a 9.4% chance that they do not cut in September. 90% chance they do. Place your bets, ladies and gentlemen. Revolving consumer credit, owned and secured, is down. This goes back to the thesis that the consumer has a healthy balance sheet. Lower rates will enable them to unlock $1 trillion of home equity that's been captive, which is going to be a huge, huge stimulus to the economy. The weight of the biggest stock in the S&P 500, you can see at different peaks going all the way back to GE in 1994 and 2006, etc. Market cap weight of the top 10% largest stocks, again, 75%. This is not the time historically you want to be in those top weighted stocks. Maybe this time's different. That seems to be the consensus narrative until it changes. I can tell you with the amount of CapEx spend and the margin compression, I wouldn't bet on it. It's not to say they are not going to do unbelievable things and all of the amazing things that AI is going to bring won't happen. They will, and probably way more than we can imagine. And the benefit to productivity will be beyond anything we can imagine. And it's going to help a lot of companies that aren't named NVIDIA. It's going to be the application of the commodity that will become AI into real businesses that is going to grow margins, productivity, and create a lot of more jobs than people think. They think it's going to cut a lot of jobs. I think it's going to create a ton of new jobs, like every single technological revolution since the dawn of man. The macro volatility that characterized the April quarter has given way to a rebound in single stock volatility this quarter. Okay. Price changes for selective market classes. Compact cars were down, mid-sized cars were down. So you can see in the Manheim that this supports the affordability thesis. Year-to-date performance of Dow components, you can see UNH is a big negative weighting. The software stocks are getting hit because of the fear that AI can recreate a lot of these software quote-unquote moats in minutes for low cost. Probably a little bit overshoot on the Adobes of the world, but probably not unrealistic either. So it's something to keep in mind. Seasonality here we need to be responsible about. This is what we're talking about. Doesn't mean it's a crash. It could just mean a little sideways consolidation. I do think, though, because everyone is mired in recency bias, if you're wondering what I'm looking at, by the way, portfolio, the markets, we're recording this midday. I stay on top of everything. I can hit pause when I need to hit pause, and that's what I love about the business. I do think, though, because people are so traumatized still by that April sell down, especially a lot of managers that sold in the hole, that they all are, that pain is so present, and that creates a lot of recency bias that they're thinking they're going to get something like that during this period because, oh my God, if the correction was that bad in April, what's going to happen in the seasonally weak part of the year? And usually when everyone's looking for that correction in the seasonally weak part of the year, because that's what all the talking heads are talking about, the pain trade could surprise to the upside and really destroy people who sold in the hole. So market likes to cause the most, the market likes to cause the most amount of pain to the most amount of people at any one point in time. That's how it's designed. And the thing that would cause the most amount of pain to the most amount of people right now, certainly the institutions, would be to keep pushing higher. And especially in the high short interest stocks as well, which is kind of the next phase of it. Revenue per employee. Global EV sales are still climbing. Again, that's the China story, Albemarle. The tech giants are boosting CapEx. That's, again, going to be a margin story. Major Trump-related corporate pledges in the U.S. We're talking about investment in the U.S. Apple, $600 billion, 20,000 jobs. Stargate, $500 billion, 200,000 jobs. That we'll see. NVIDIA, $200 billion. TSMC, $100 billion. So there's a lot of investment coming back. That's very, very good for the economy. Household debt service ratio, again, supporting what we're saying, the lowest going back 40 some odd years, excluding the pandemic the pandemic lows there in 2000. But like excluding that 1 in 100 year event, it's the lowest it's been still in 45 years. CapEx growers underperform, so keep that in mind. The ones that are increasing a lot of CapEx are historically tend to underperform. Everyone's excited about all the CapEx of the Mag 7. It would fly in the face of logic historically that they will be the outperformers. Usually for that to work, the pace of EBITDA growth has to exceed the pace of CapEx growth, and that's not the case in any of them as far as I can see. AI adoption starting to deflate the U.S. labor market, so that gives the Fed. We had one speaker out talking about we need to focus more on the employment side of the mandate. That clears the path for September. Multiples have plenty of room to rise. This is S&P equal weight price to earnings ratio hasn't moved higher after 6 black swan events. So we could definitely see the multiple expansion in the non-heavy weighted stocks. The highest mortgage rate U.S. homeowners say they would accept on their next home purchase. So the sweet spot seems to be right under 6, as I've said. I think we're going to get there before the end of the year. And I also think, and again, this is not what I do for a living, but I have a strong feeling that when mortgage rates hit 5.9, 30-year fixed, oh, and by the way, that's going to lead to a mass proliferation of 7-in-1, interest-only resets, ARMs, 5-in-1, all that crazy stuff is going to come back. So for those who say short rates don't affect mortgage rates, they're going to be totally effing wrong, because the new product that banks are going to push out again to create fees is going to be massive. Because if you have a Fed funds rate at 350, and you go 350 plus 200 on interest only for 5 years adjustable mortgage, you got 550. 550 on an interest only is a low payment on any house. And what's going to happen is this $1 trillion of locked up equity, which is a lot of older people, baby boomers, who no longer need 7 bedrooms and an indoor pool and a movie theater, are going to all dump at once. They're all going to hit the market at once. Right now, here's the joke. The joke is on them, because they're all holding back their properties because right now the market's a little uncertain. You've seen the top in most areas in housing prices. So they're like, well, I'm not going to put it on the market and let it sit because no one's giving me what they would have given me last year. Once they cut rates, I'll get more than I would have got last year. And what they're going to find, especially with the super high end, look, I'm in Orange County. I think the 20s, I think you're going to start to see some of these 20s hit the market for 12.5. As for the 5s and 7s, $5 to $7 million houses, they may retain their bid because there's just an enormous demand at the lower end of the market. But I do think some of these 15s and 20s that were worth 7 and 8 before the pandemic are going to hit 10s and 12s, and maybe some will even go back to 7 and 8. I think that air pocket's going to be lift. And I'm totally willing to be completely wrong because I focus on stocks, not on real estate. But my instinct is everyone's consensus view that when rates go down, prices are going to start to go back up again. I think is going to be opposite. I think what's going to go up again is going to be massive supply all at once, and it's going to be a buyer's market with cheaper capital. And I think the supply is going to outstrip the demand in the short term, particularly for the higher end. That's just my 2 cents. Discretionary investor positioning is well below levels implied by the strong upgrades to consensus earnings estimates. So there's room there. Then you've got Russell 2000 versus S&P funding. Again, levels not seen since mid-24, which supports the small cap thesis. Russell 2K, Russell 2000 hedge fund short dollar notional has not been this high in 4 years. You want to take the opposite side of where hedge funds are, all crowded short. And that's why you saw such abrupt, amazing moves this week. US large cap equal weighted to market weighted stock market relative total return. What this is pointing to is we are at a low of unmagnificent 493 performance versus magnificent 7, that a low level that in every instance, 2008, 2000, 1990, 74, led to years of unbelievable outperformance of small caps following those periods. So you can see it here every single instance. This is really valuable from Jim Paulson, who, by the way, probably one of the best commentators ever in the history of markets. It's a shame he's retired. And he was with a small firm called Leuthold, so he didn't get as much spotlight as he should have. Literally one of the best. Literally one of the best. U.S. stock buybacks yearly. Again, underpinning for the market. Dips are going to be bought. U.S. equity market concentration, historical highs. So look, you can keep saying, look, it's the same chart last year, whatever. Okay, bet against it. Okay? .com bubble, Nifty 50, AT&T GM and IBM in the 60s, etc. It doesn't mean we're going to get a market-wide crash or anything like that. I think we're going to get underperformance of the overweighted concentrated because their margins are compressing and their earnings growth is collapsing. I'm just calling it facts. Earnings, absolute earnings, going up. Earnings growth ratio, collapsing. Mid-30s down to this quarter will be the first quarter at 10% or below for the Mag 7. So keep buying them, sold to you. But I don't think you're going to like the outcome. I think you're going to love the outcome of the type of stocks that we're doing here. And you're already seeing it like gangbusters this year. So data center energy demand will grow from 5% of total U.S. power demand today to more than 10% in 2030. That's our Comstock Resources play. Patience, it's just unbelievable, along with Generac, by the way, which has doubled nearly. Historically, 50% probability of outperformance in international equities. Based on the underperformance. So this is just going back to the normal cycles. We were big on this going into this year when no one would listen to us, and internationals outperformed domestic by 10 full percentage points. Record net, 91% of fund manager survey investors say U.S. equities are overvalued. They say emerging markets are undervalued. So once the coast is clear on a China deal or China earnings or them seeing more results from the stimulus, which we've been seeing, it's going to be a panic buying into those because Mag 7 is going to start to really hurt their books. And they're going to say, where can we get it? And then once one, the whole flock follows. And my guess is 18, 24 months from now, we'll be laying off a ton of China stock to these lemmings. And that's really what it's going to be about. I mean, there's no other way to explain it. Long Mag 7 is once again seen as the most crowded trade. That's exactly what it was right before the August massive correction. Manager now starting to get overweight EM. I think this is early stages, emerging markets. Wow, we got a lot of charts this week. Consumer balance sheet goes to the fact that very unlevered. Earnings revisions going up. Like we talked about, expectations were 4.8% earnings growth, over 11% now, which is mind-boggling. This is from Carson, slowing economic momentum, but no sign of recession yet. So something to keep an eye on, but that can last many, many years. It was in this range from 2009 all the way to the pandemic. So this can last a long, long time. Mortgage debt is a little less than 1/3 of the housing market, lowest level since the 1950s. Again, trapped equity. Again, consumer deleveraged. Okay, stocks that cut guidance on average are down 10% out earnings this quarter. That raised guidance are up only 4.3. So there's this trepidation in the market. Again, top weightings, people are getting it. Healthcare is the laggard. That's where I'd focused. AI exposed, that had been the short-term leader. I'd be trimming that and looking for the AI beneficiaries, not the AI names. Different gravy. Here we go. Tech versus S&P price relative. Again, you go back to 2000, you go back to 1970s. It's the same story. Everyone said it was different with .com and this and that. I just don't think we're going to get a pronounced downturn. I think we're going to get relative underperformance. S&P 500 versus EFA outperformance and DXY index. So what you can see here is as the dollar weakens, you get these multi-year periods of international equity outperformance. And as the dollar strengthens, you get these multi-year periods of dollar equity outperformance. We are in a weakening regime of the dollar, which is just beginning, which means international will outperform. And the big play, what's the second largest economy in the world? It's called China. And that's going to be an enormous part. They're all underweight, just like they were energy in the pandemic. They're underweight China. They'll all catch up like lemmings, and it will. You'll be able to benefit as the intelligent, incredible, loyal viewers of Hedge Fund Tips with Tom Hayes, because you now are able to independently think for yourself and not get caught up in the headline noise. July CPI follows a string of soft releases. The absolute forward PE for the Russell 2000 as of month end suggests 9% annualized 10-year returns as of month end. So what they're saying here is the Russell 2000, just like all cyclical periods, is going to outperform. I'll bet if you did this regression on the S&P 500, it would imply 5 to 6%. I think Vanguard is even lower than that on the S&P. I think that's too conservative, but you're basically talking about a 3 to 4% outperformance spread on Russell over the next 10 years. Business optimism continues to climb. Worst performing stocks in the S&P 500. This should be, Lulu continues to pop up as interesting. Obviously United, but they got the DOJ. Dow. So there's some stuff to see here. Growth versus defensive ratio of healthcare and technology, the lowest since 2000. You can see Baxter up today with a little volatility. Biotech, we have the exposure. I just continues to nag me that I want a little more exposure to healthcare at these generational relative low prices. Hedge fund length in U.S. index futures, so they're net underweight, which that's not where you want to be, because that's where they were in 2020, and you had another year plus of straight up gains. So keep it in mind. EPS crushing preseason estimate by 7.7%. That's pretty amazing. One of the highest beat seasons of many, many years. That's from Kelly Cox. She puts out some good stuff. Data center versus office construction. General office supplies going down. Data centers going up. That was the play, ladies and gentlemen. If you were listening to the podcast, and a real estate guy, I was pounding the hell out of it when we bought Vornado and doubled in a few weeks. I said, if you're a real estate person, you need to be strongly looking at New York City office and San Francisco office. And most of those cost per foot have now doubled and tripled. So I hope some of you took advantage of it. Oh, and by the way, if you did, send me some money. Okay, let's manage some of those profits for you. Is the name of the game. So, all right, and this is really good. There are only 2 times in history where the oil to S&P 500 ratio was lower: 1999 and 2020. And by the way, those were generational opportunities to buy companies like Comstock Resources and National Oil. Well, Varco, particularly 1999, 2000, 2001, something to keep in mind on, something to keep a close eye on. We have our exposure in energy. We're comfortable with that level. We were able to add Varco to Comstock. So that's that. Discretionary investor positioning has been capped at neutral since the tariff escalation began in early February. Interesting. So they're still underweight. So paying trade higher. Near record 10th largest week for institutional client inflow since 2008. So we're getting towards since 2008. That's interesting. So we're getting towards getting everyone back in the boat, but I don't think we're fully there yet. We find that 9 out of 13 U.S. regional power maker markets have already reached critical tightness this summer, while expecting all but one to reach critical tightness in 2030. Again, supports the Comstock, supports the Generac. Yes, the Fed has cut near all-time highs, and the bulls loved it. So when the Fed cuts at all-time highs, on average the next month, markets up 0.1%. 6 months later, up 3.4. Year later, up almost 14%. Hat tip to the guys over at Carson. Looks like Ryan's work. XLV sector starting to get a little bit of a bid. S&P stocks versus short interest, pretty high short interest level. You see towards bottoms, but US PPI index higher than expected. Excess returns for small cap stocks, rolling 7-year periods. You can see going all the way back to the beginning of the 2000s. That's when you want to be a buyer or sell small caps, not a seller. The time before that was the late 70s. The time before that was the time before that was the late 80s, then mid 70s, then mid 50s. You get the point. This stuff all goes in cycles, and it's when everyone thinks that this time is different is when the cycle shift begins, and it's already begun. 30-year fixed mortgage rates, you can see them trending down. Total card spending rose 0.6% month on month in July, following a 0.4% month on month in June. This is the consumer re-levering. We're going to see retail sales later this week. May was the second highest ever month for net purchases of overseas equities by U.S. investors. Small cap surge, that was yesterday. Mega cap stocks underperform housing related stocks over the past month in percentage gains. Pretty exciting to see. Mag 7 down, small caps up. Real estate ETF versus S&P, again, lowest going back to 2000. The CCIs of the world, they're going to go up. We probably need a little more exposure because that's a play on rates coming down as well. We're comfortable with CCI, but maybe a little more. I mean, we don't want to have double of everything. I mean, you know, we want to be concentrated, and we want to be so. But for those of you who are, you know, doing your own thing, there's just so much amazing opportunity. All right, global equity returns. International is dramatically outperformed, led by Greece, of all things. Who would have said that in 2008 or 2011, rather? Worst has been Saudi Arabia. Interesting. India has been among the worst, by the way. People couldn't get it fast enough at the top a year and a half ago when we were like, get out, go into China. China's going up huge. We will probably wind up taking our China profits in the next 2 years and going back into India for the long term. They do have the most favorable demographics. Equal weight looking ready to break out in a major way. Boy, I didn't think we were going to have all this on a already amazing week with growth Bracken. That was amazing. Okay. So some left behind large caps, Charter, Lulu, staples like General Mills, Danaher, Schlumberger, we've got our exposure there. Adobe, I think that's going to work, but yeah. Allocations to equities are near their highest level. By whom? That's from State Street. Retail options, put call direction by week. Longest retail weekly option buying streaks on record since 2020. Well, they were right. They're buying a ton of options in 2020 and they made super bank. So futures, short liquidations. Homeowner households have been declining. U.S. business applications going straight up. AI companies are spending hand over fist. That's a margin story. Earnings estimates hit new highs, by the way. Okay, this is forward at 321, 24 month. Okay, that's from Cali. Car dealership guy. Auto loan applications rejections are plummeting, meaning credit is loosening. Anyone who wants a car gets a car. In Q2, only 6.7% of borrowers reported being denied for their auto loans, a sharp drop from the whopping 19% in Q2 2024. So in Q2 2024, you wanted a car, A, the rates were high, and B, you got declined. Now rates are getting a little lower and everyone's getting approved. So the spigots are opening up. The incentives are going up. Here is the tariffs are currently generating over $300 billion in revenue, an increase from closer to $80 billion a year ago. That's the run rate. So Trump is, bridging the deficit in his own way in that regard. Annual CPI inflation rate. This is from Paulson. Blue left scale versus Citi US Inflation Surprise Index. So the surprise index is collapsing. The inflation rate tends to follow that. I think that this PPI is going to prove to be a short-term fake out when we look back 90 days from now, because if you look at the overall surprise indices, they're down, and that will catch down, not up. Credit spreads still under control. S&P 500 members outperforming the S&P index trailing 60 days. You haven't seen this low since early 2001, which is our analog for a lot of the names that we own, which did nothing but go straight up over the next 6 years from 2001 to 2007. Value, small caps, international. Small caps remain historically cheap versus large caps. You can see it here. Almost dramatically low, lowest since 2001. I mean, it's amazing when I see this every week. It just gets me so clear, zooming out and seeing like I'm like a kid in a candy store. I'm so excited. And there we go. Moving on. We miss any Slumer here? 30-year yields. 10-year yields working down. Euro, look at this move in the euro. No one was calling for that. Fourth quarter, we're like, it's coming, and it went against us, and then boom. Canadian dollar, all my Canadian friends smiling so wide they could eat 2 bananas sideways. Oil should start to find some support somewhere between here and $60, $59. Gold price has been kind of losing momentum here, stalling. See if there's anything else we want to cover here. You can see a lot of the software stocks breaking down. There's probably going to be a pony in that pile somewhere. All right, that looks like it from Slumer. All right, let's get to some news. Advanced Auto Parts earnings beat by 0.16. Revenue topped estimates. So they beat on the top and bottom line. Why is the stock down? You can see this article here from Nate Wolf. We'll do a comprehensive next week. They lowered their guidance from midpoint 170 from midpoint $2. The revision accounted for higher net interest expense related to the company's offering of $1.95 billion in senior notes last month. That is going to get refinanced in the next 3 months. So this is a non-issue in my view. As rates come down, these guys are all going to hit the window at the exact same time. But in the meantime, we get to build some position here. I don't know if it's going to get low enough for us to add more because our basis now has gotten really low, 40s, some in the 30s. But yeah, so I don't think this is an area where we're major buyers, but we would definitely, in the next few days, any $5 million accounts come in, we'd probably start to build a position here for sure. China consumer loan subsidies seen driving trillions of new credit. Their mandate, as I talked with Ash, to get to 70% consumption is well on its way. China's $11 trillion stock market stages steady resurgence. 2.7 billion of global funds swarmed Chinese stocks in July, and the flow will be bigger and stronger. Long-only funds poured 2.7, and global interest should be stronger after summer, the bank says. China trade deal deadline extended to early November. China stocks turnover tops 300 billion as bulls take charge. That's from yesterday. Besson urges Fed to lower rates by 150 basis points or more. He qualified that, but that's where he thinks neutral is. We generally agree. We think it's a little lower, but that's fine. Homeowners rush to refinance as mortgage rates plunge, opens window of opportunity. The only one that's going to benefit from this is the mortgage brokers and mortgage originators who are going to be refinancing them every 90 days for the next 2 years and making their points every single time. Moving along, small caps rally as Magnificent Seven stocks roll over in market rotation. Hedge funds have never been this short small caps. Time for a rip your face off rally. Investors pile into cheap emerging market stocks. Bank of America survey shows. This is tomorrow's newspaper today. Go back to our Q4 last year when we were talking international and all of this stuff, and everyone looked at a weaker dollar. You couldn't find one person talking that. So S&P, except all of the incredible, loyal, amazing listeners of Hedge Fund Tips with Tom Hayes. S&P 500, healthcare weighting at multi-decade lows. Last time I saw this type of headline, I made a fortune on ExxonMobil stock at $33. That was during COVID. EV sales soar as Trump axes 7,500 tax credit. People are rushing out to buy. That could be good for Cooper in this month's quarter's production. Ford boosts EV investment plans with focus on budget models. Lithium market soars as Cattle shuts one of its world's top mines. Lithium prices and stock prices spiked after contemporary Amperex Technology Co. halted operations at a major mine in China, spurring speculation that Beijing might move to suspend other projects. The mine's closure had been under scrutiny for weeks amid speculation that authorities would not extend its license, and it accounts for some 6% of global output, according to Bank of America. The stoppage has led to speculation about a possible crackdown on the lithium sector, which is suffering from oversupply, with some analysts saying it could be part of the government's anti-involution initiative to tackle overcapacity. And Albemarle is singing the same tune, ladies and gentlemen, early effing days. Moving along, President Trump calls Intel CEO a success after meeting. It's like, look, you could have just invited the guy out for a coffee. Instead, you got to take his children hostage so he comes to Washington. But that's how Trump negotiates, I guess. So I guess that's moving in a positive direction. ESPN ditches pay TV first model with a $30 a month streaming app. That's going to be a monster for Disney. American companies are buying their own stocks at a record pace. Boeing's $4.7 billion Spirit AeroSystems deal cleared in the UK. Price spikes and blackouts. America's power crisis is just getting started. We love you, Generac. Full volume ahead, stock market and sentiment results. We're on to the article of the week. On Monday, we put out a summary of the monthly Bank of America Global Fund Manager Survey. You can find it here. This month, they surveyed 197 institutional managers with $475 billion AUM. Here were the 5 key points. Number 1, managers are slowly starting to turn bullish on China with a net 11% now, expecting a stronger Chinese economy, up from only 2% in July and reaching the highest level in 5 months. 2, a record net 91% of fund managers say U.S. equities are overvalued, up from 87% in July. Emerging markets are viewed as the most undervalued, with 49% holding that view, the highest since February 2024. Rotation, rotation, rotation. 3, 45% of managers see long Magnificent 7 as the most crowded trade, reclaiming its crown yet again. Last time it held the crown, March. We know what happened next. They got hit more than the general market. 4, equity allocation among managers rose for the 4th consecutive month to a net 14% overweight, but remains well below the 24-year average of net 25% overweight and the recent December 2024 high of net 49% overweight. This continues to reinforce our view that the pain trade is likely to the upside, with trapped bears still stuck on the sidelines and becoming forced buyers as we continue to work higher. Healthcare has been left for dead, with just a net 2% of managers overweight the sector, 1.6 standard deviations below its long-term average. This is down 16% month over month and marks the lowest level since January 2018. Meanwhile, the sector is at its lowest weighting in the S&P in nearly 25 years. There are plenty of ponies in this pile. Here's the healthcare weighting, lowest going back to 95. GXO update. GXO Logistics, baby. Each week we try to cover 1 to 2 companies we've discussed in previous podcast, VideoCasts, and or own for clients, including myself. I eat my own cooking. I eat so much of it, I'm glowing. I'm smiling so wide I can eat a banana sideways. So here we go. We can see cash flow's been a little bit weak. We understood that going into the story. And we're going to talk about what's next. Revenues are going through the roof because they've done acquisitions. So how is the revenue turning organically and inorganically? Well, we got some major catalysts. First off, GXO delivered another lights out quarter last week. Revenues at $3.3 billion, came in $200 million ahead of consensus, beating by 6%, while adjusted EPS of 57 cents topped 55 cents. On top of that, management raised full year guidance for the second time in 2 months, as every sign points to an inflection and acceleration in the business from here. We first got involved with GXO nearly in early 2024 with a solid starter position and intent to add on any weakness. Luckily for us, the market gave us plenty of chances and we took full advantage. What originally attracted us beyond GXO being a Brad Jacobs company spinoff from XBO in late 2021, with him still holding 1.7 million shares, was its heavy exposure to Europe and international markets. In fact, GXO generates well over 70% of its revenues from outside the US. For nearly all of last year, and until we were blue in the face, we pointed to the cyclical nature of international and US equity outperformance and how they often track US dollar cycles, with international equities left for dead after a record long 16-year stretch of underperformance. This was an area ripe with opportunity. At the time, we were on an island with that call. So you can see the data here, strong dollar, weak dollar, and what happens to international. At the time, we were not on an island, but with the dollar now down 10% year to date and international markets trouncing US equities by a wide margin, 19% versus 9%, it's suddenly all anyone wants to talk about. Most importantly, GXO continues to be a direct beneficiary. Shortly after its spin from XPO in late 2021, GXO found itself caught in the middle of a once-in-a-100-year destock restock cycle. The stock sold off in concert with the shift from goods to services following the pandemic, with organic growth falling from 15.4% in 2022, which was 2% by year-end 2023. Management took advantage of the cyclical drawdown and used its strong balance sheet to go shopping at sector-wide trough multiples, acquiring Clipper in 2022 for $1.3 billion at 13 times EBITDA, PFS Web in 2023 for $142 million at 7 times, and most recently Wincanton for $958 million at 7 times EBITDA. Fast forward to today. Volumes and inventories have largely normalized. This quarter marked the 6th consecutive quarter of organic growth and the strongest print in over 2 years at 6%. While fundamentals have clearly improved, 2 temporary overhangs kept a lid on the stock: the CMA's extended Wincanton review and the surprise retirement of CEO Malcolm Wilson. The good news is that with this Q2 report, both are now in the rearview mirror. Earlier in the quarter, the CMA approved the Wincanton deal, and with GXO agreeing to divest roughly 5% of lower margin grocery contracts. Integration between the two businesses will begin in the coming weeks, unlocking $60 million in cost synergies and opening new opportunities in higher growth verticals like aerospace and defense. On the leadership front, Patrick Kelleher, a 33-year-old industry veteran and most recently CEO North America at DHL, the largest logistics company, will take over on August 19th. He will be joined by a refreshed board with 7 top-notch new members, all handpicked by Brad Jacobs. With the smoke cleared out, the market is finally waking up to what we've been pounding the table on for months: record high revenue, highest organic growth in 9 quarters, $2.4 billion sales pipeline, and guidance raised twice in 2 months. All of this from a stock that was hitting fresh all-time lows just a few months ago. And the best part is that despite the beats and raises, guidance still looks awfully conservative. GXO has already booked $795 million in incremental 2025 revenue through Q2, assuming 95% retention in line with historical averages. That alone translates to 6.45 organic growth with 0 additional contract wins. So even with flat volumes and no new business for the rest of 2025, GXO would be at the high end of its organic growth range. We think this sets a low bar for material upside in the back half. The bottom line is that GXO is back, baby. And as the business accelerates, we expect a re-rating from trough multiples towards levels consistent with a double-digit grower and a cash machine. Machina, as my 11-year-old who studies Duolingo Spanish would say. By comparison, its former parent XPO Logistics trades at an average annual PE of 25 times. That sets up a clear path to what we believe is a double over the next few years as the story unfolds, and maybe more. This was a textbook Great Hill Capital setup, a high-quality compounder with recovering fundamentals while price lagged due to short-term noise and uncertainty, trading at a valuation that assumed the cycle would never turn. The cycle has already turned. The market is still catching up. We are not. So you can go through the key points. We have underlined the key points of the earnings release, starred the ultra important points, and gone through the deck for you. 10 key points. Q2 revenues reached a record of $3.3 billion, up 16% year over year. Organic growth was 6%, the strongest in more than 2 years, accelerating from 2.8% last quarter and improving across every region. Most importantly, management said customer inventory levels are largely normalized, implying the acceleration wasn't driven by pull forward demand. 2, GXO booked new business wins of $307 million in annualized revenue during the quarter, up 13% year over year. This brought total incremental revenue for 2025-1 through Q2 to $795 million, and incremental revenue for 2026 to $513 million, a company record through the first half. More than half of those wins came from e-commerce, which is also driving outsized growth in the higher margin reverse logistics returns business. Reverse logistics now accounts for roughly 10% of the pipeline and a high single-digit to low double-digit percentage of revenues. 3, the total sales pipeline remains about $2.4 billion, up year on year, and still excluding the Wincanton sales pipeline. Since the last full year before the spin, the pipeline has grown by more than 1/3 and is more diverse than ever, with roughly $500 million tied to industrial and aerospace and defense, and a segment that has doubled over the last 18 months. 4, earlier in Q2, GXO received final regulatory approval for the Wincanton acquisition, agreeing to dispose of roughly 5% of the business tied to lower margin grocery contracts. Wincanton continues to perform well, delivering 10% of revenue growth on its own in Q2. That's amazing, by the way. Management is set to begin integration in coming weeks and expects to deliver the majority of the run rate $60 million in cost synergies by the end of 2026, which is ahead of prior expectations. This will be a major driver of EBITDA, margin expansion, and also is expected to generate significant revenue synergies, particularly in the key industrial and aerospace verticals where Wincanton has significant exposure. Management is already working on very large bids in the aerospace and defense verticals, expected in the back half of 2026, with scale comparable to the landmark 10-year, $2.5 billion NHS contract. 5, as part of the $500 million repurchase program announced in February, management bought back 2.6 million shares during the quarter at an average price of $34.86. This is why I love Brad Jacobs so much. I mean, this guy gets it. This guy gets it. You have all these morons buying back, let's just call it large cap tech at record high valuations, and right before they're going to normalize in terms of multiples. And then you have this winner, consistent wealth creator, buying back stock at the absolute lows when all the other management would be hunkered on their desk like a bunch of bitches, crying in their soup. He's in the market buying stock hand over fist and increasing our and his share of the pie, because he owns a lot of stock, with no new money out of our pockets. Kudos. Really amazing job. This brought total repurchases for the first half to 5.4 million shares, reducing shares outstanding by 4% at an average price of $37.34, which represents a 26% discount to the average share price over the last 30 trading days. 6, free cash flow during the quarter was an outflow of $43 million compared to $31 million generated in the same period a year ago. However, this was primarily due to a one-time payment for a regulatory item recorded last quarter. Management remains on track to deliver the full year target of 25 to 30% adjusted EBITDA to free cash flow conversion, which implies $262 million of free cash flow at the midpoint. 7, net debt stood at $2.5 billion at the end of the quarter, bringing net leverage to 3.0 times. Management top priority is deleveraging the balance sheet, ideally to between 1.5 and 2 times over time. Liquidity remains strong at $1.2 billion as of the end of Q2. After receiving an upgrade from Moody's in June, GXO now holds an investment-grade credit rating from all 3 major agencies for the first time since the spin. Let me repeat that. After receiving an upgrade from Moody's since in June, GXO now holds an investment-grade credit rating from all 3 major agencies for the first time since the spin. Why is that important? Lower cost of capital, so that if they can find more and more businesses at 7 to 9 times, subscale businesses, issue debt at a low rate, which is going to get lower over the next 3 months, and then get a re-rated high multiple on those earnings in the public market. Rinse and repeat. That's why he's created so many tens of billions of dollars of wealth for his owners and himself, because he gets it. Number 8, operating return on invested capital during Q2 stood at 46%, well above the long-term target of over 30%. And number 9, with over 70% of revenues generated outside the U.S., a strong dollar has been a headwind for GXO. However, with the dollar now down 10% year to date, it's becoming a meaningful tailwind for the company, which was part of our original thesis. GXO does not hedge revenue, with the favorable FX rates driving 4% of the 16% revenue growth during the quarter, or $127 million. Amen. Hallelujah. Number 10, After already raising full-year guidance back in June, management continues to see strong momentum across the business. With over a third of Q3 complete, Q2 trends have remained consistent so far this quarter, along with strong planning for a good holiday season already underway with customers. That gave management enough confidence to raise full-year guidance for a second time in 2 months. For 2025, they now expect to deliver organic revenue growth of 3.5 to 6.5. Adjusted EBITDA is expected between $865 million and $885 million. Adjusted diluted earnings per share are forecasted at 2.43 to 2.63. Finally, adjusted EBITDA to free cash flow conversion is projected to be between 25 to 35%. Again, we highlighted all the important facts for you. Put stars next to the super important facts, and you can go through that on hedgefundtips.com and just scroll down to most popular posts, and this will be right at the top. Cooper Standard update. Look at all this free cash flow, ladies and gentlemen. We got in mid-2022 when it was looking most glum. Look at what's happening. Reacceleration of revenues, positive free cash flow, margin reacceleration, return on invested capital turning positive, and so on. Cooper Standard raises full-year adjusted EBITDA guidance as second quarter and first half results exceed expectations. And they're doing that on anemic estimate in volume, which will prove to be far too conservative. This is exciting. Midpoint to $235 million on EBITDA from $217. That's a big jump, particularly considering they took down the estimate of North American production, which I think, again, will prove to be too conservative, but they just follow what S&P publishes, and S&P is wrong as often as it's right. So you can see the deck we put here. You can see ample liquidity, $272 million. You can see the cost per vehicle. We've gone through this a million times, but the 10 key points were: number one, management continues to deliver significant margin improvement. Jeff Edwards is hitting on all cylinders, with gross profit margins reaching 13.2% for the quarter, up 150 basis points year on year, and adjusted EBITDA margins at 8.9%, up 170 basis points year on year. Keep in mind, this margin expansion is occurring despite lower overall revenues, so operating leverage has not yet kicked in. Let me repeat that. Operating margin hasn't even begun. And if you think that this is going to be a cycle that does not reach 17.5 to 18.5 million SAR in the US, with 1/3 more population than we saw in the early 80s when it hit 17 million and change, you are smoking something that you shouldn't be smoking. This is going to be a cash machine, ladies and gentlemen. The volumes are going to be enormous, and it's coming to a theater near you. Now, margin, but will soon do so in earnest. Most importantly, management continues to expect to hit their long-term goal of reaching double-digit margins as they exit Q4 and head into 2026, with management saying they should be, quote, shocked if we don't. Double-digit margins on still anemic volumes is execution cubed. You can't get better than that. Number two, management released long-term 2030 financial targets for the sealing systems business, where they are the global leader. CPS expects the segment to deliver greater than $1.8 billion in revenues, up from this year's projected $1.4 billion, a 6% CAGR, adjusted EBITDA margins of 13%, greater than 13%, up from this year's projected 9.25%, and return on invested capital of greater than 20%. What will prove to be probably 220% of S&P returns. Up from this year's projected 10.5%, 25%. At base level assumptions, this implies $234 million in adjusted EBITDA from the ceiling segment alone. Let me repeat this, ladies and gentlemen. At the base level, this implies $234 million of adjusted EBITDA from the ceiling segment alone, essentially the midpoint of what the entire company is projected to deliver this year, meaning they're going to double EBITDA in the next 4+ years. Most importantly, these aren't pie in the sky projections. 80% of the incremental revenue is already booked. Volumes assume the mortician's forecast and never exceeded 15.3 million SAR in North America. And the current vehicle mix remains the same, with no benefit assumed from increased hybrids, which adds 80% cost per vehicle, or EVs add 20% cost per vehicle. Meaning, the writing is on the wall for material upside to these conservative projections. Number 3, management also released long-term 2030 financial targets for the fluid handling systems business. You want to talk magic GPUs? I want to talk fluid handling systems. The key space where they expect to unlock the full potential of the organization, end quote, as they leverage growth in hybrid trends. CPS expects the segment to deliver over $2 billion in revenues, up from this year's projected $1.4 billion, an 8% CAGR, adjusted EBITDA margins greater than 16%, up from this year's projected 9.25%, and return on invested capital greater than 30%, which will probably prove to be 5x the S&P compounded annual growth rate for the next 6 years, maybe 4x, up from this year's projected 13.25%. Similar to the ceiling projections, these are based on the same mortician forecast assumptions at the base level assumptions. This implies $320 million in adjusted EBITDA from the fluid handling segment alone. Combining both segments, the 2030 projections imply CPS delivering $3.8 billion in revenue and $554 million in adjusted EBITDA, or 14.6% margins. For context, in 2017, CPS delivered $3.62 billion in revenues and $452 million in adjusted EBITDA, a 12.5% margin, which earned $7.21 in earnings per share. The stock traded up to $146 per share on these numbers in 2017. Ladies and gentlemen, this thing is just getting started. So if it generated $7.21 of earnings on $452 million of adjusted EBITDA and traded up to $146 per share, which is a 20 times multiple, let's do a little math, ladies and gentlemen. $554 million in adjusted EBITDA at 14.6, higher margins. When I talk about, doubles from here, I'm being retardedly conservative in my view. And that's not the right word, but I'm retarding my enthusiasm is the right way to put it. So that's that. I'm excited about that one. This is all my opinion. This is all our models. We could be completely wrong, but so far we've been damn right. And I think that's going to continue in material ways. And I do think this thing's just getting started. So next, free cash flow during the quarter was an outflow of $23 million, in line with Q2 of last year, despite cash interest paid being more than $14 million higher this year. The outflow is largely due to working capital timing and reflects the normal seasonality of the first half. More importantly, management continues to expect this headwind. Look, I'm thinking about the last point here. I've tried to be conservative, talking about, because of the execution and the cost that they've taken out of the business on the same revenues, they'd earn $10 a share. They're telling you they're going to do more revenues. And here's the thing. The stock market is not going to price in that outcome in 2031. It's going to price in that outcome in 2027, 2028. It's going to start to look ahead as they start to execute. And this thing is going to get multiple expansion, and people are going to be euphoric, and they're all going to start saying this time, when the stock is in the hundreds, they're all going to start saying this time is different. They, have a secular thing with a special rubber or whatever. And it'll be, 150, maybe it'll be $200, $10 of earnings, 20 times multiple. Okay, that's the rainbows and unicorns scenario. And we'll help them out. And we'll give them all the stock that we bought at $5 and change, and a little bit at $3 and change, and some more at $7, and we'll help them out. And that's all we do, ladies and gentlemen. Rinse and repeat over and over. Play the time arbitrage game, low leverage, buy great companies, know what you own, and that's the story. Back to cash flow. This is despite the $55 million in cash interest paid in June, which will be repeated in December, meaning positive free cash flow despite $110 million in total interest payments. Management expects this positive free cash flow combined with hitting the midpoint of previously stated full year guidance will result in a net leverage ratio below 4 times by year end. 5, Cooper Standard continues to evaluate options for strengthening the balance sheet and is monitoring conditions in the credit markets. With a global refi on the table during Q2, CPS received an upgrade from Moody's, moving their outlook from stable to positive as management believes they are on the cusp of a ratings inflection point, potentially reaching the single B territory. CPS is working to refi both the $612 million, 13.5% first lien notes and the $338 10.625 third lien notes, both maturing in 2027. The upside implications of getting this done are material. For example, if management is able to refi both loans at 9%, this would save $34 million a year in interest expense, or $1.93 a share pre-tax, implying a trough multiple to those savings alone gets you to near today's share price. 6. CapEx during the second quarter totaled just $7.8 million, or 1.1% of sales. This is well below last quarter's 2.6% and just a fraction of the bloated heyday averages of 5 to 6%. Levels management that has no intention of returning to. For the full year, management continues to expect $45 million to $55 million in CapEx, or about 1.8% of sales at the midpoint, with the focus firmly on disciplined investments and getting back to double-digit returns on invested capital. Number 7, CPS secured $77 million in net new business during the quarter, bringing the first half bookings to $132 million. The company also earned several key supplier honors, including Ford Supplier of the Year, selection for the Renault Group, Embleme project, the Toyota's Excellent VA Achievement Award earlier in the year. Management views these recognitions as strong signal of future opportunities to win profitable business, noting that relationships with key customers have never been better. Number 8, management continued to execute on the cost optimization program, removing $25 million in manufacturing and purchasing lean savings, another $4 million from the restructuring and headcount reduction program announced last year. This brings the total cumulative sustainable cost savings impact to adjusted EBITDA to $687 million since inception in 2019. Taken $687 million in cost out. Talk about operating leverage cubed. 9, based on stronger than expected first half results and continued execution, management raised full year adjusted EBITDA guidance to $220 to $250 million, up from the prior $200 to $235 million, an 8% increase at the midpoint. Importantly, the raise is driven entirely by manufacturing and purchasing improvements, not higher production volumes. In fact, management expects to achieve, despite what they called a rather depressing S&P volume forecast, which they would be shocked to see materialize. Current S&P forecast called for a North American production of 14.9 million units, down from 15.1 million last quarter and well below 2024's 15.5. The bottom line is there is material upside to guidance if and when volume forecasts improve in the back half of the year. I'd bet my bottom dollar on that. 10, with the vast majority of commercial negotiations with key customers now complete, management has secured agreements that will allow them to pass through or recover nearly all direct tariff impacts in the business. How you doing, ladies and gentlemen? Does it get any better than Jeff Edwards and Brad Jacobs? What an exciting week. Well, we got growth Bracken Darrell, the next CPS in waiting. We are excited about that as well. So let's talk about sentiment, kind of mid-range, a little bit elevated. We get it. Moving on, earnings, top 30 weights of the IBD growth index, expectations up 10% for this year, up 8% for next year. Materials down 2% this year, up 1% next year. This is where you're finding opportunity. This is where it's already moved. Insider buying in international flavors and fragrances, keeping an eye on that. We saw the core CPI, core PPI numbers, et cetera. We've talked about that. Jobless claims. I mean, came in a little lower than expected. It's 224,000, ladies and gentlemen. So the labor part of the mandate needs to be paid attention to here. And we will see tomorrow retail sales. Earnings growth, 11.8% versus 4.7% with 81% of the S&P reported. And now on to the Ask Me Anything section of the podcast. If you love that, you're going to want to listen in here. If you don't, thank you for tuning in. We'll see you next week, same time, different place. But here we go with question number 1 from our incredible audience. Maya R. Hi, I know you can't talk about the specifics of your option strategy for clients, assuming you could get both at cheap prices. Do you prefer call spreads or long naked calls? Well, they're not naked if they're long. And do you like really long-term options or whichever looks cheap? It depends on the company, sector, industry, pricing. So that's the special sauce for my clients. Michael Travis, good morning. I've been a listener to the podcast for past 2+ years, slowly building my sorry. Okay. Sagar, would love to hear your take on Elevance Health. Okay, let's do ELV. That other one was a client inquiry mid-quarter, so we got to deal with that for October 1st. Elevance, let's take a look. Yeah, look, there's going to be Elevance we get every week. There is going to be a time. Let's look at the balance sheet. So what is going on with this? Elevance. There we go. Health benefits company. Da, da, da. All right. Yeah, just from a lot of experience, I don't know that this one's fallen enough yet. I think the fundamentals might be done falling. I'm not sure if the price is done falling on this one. I don't have a lot of historical experience with this one. Let's just take a look. Balance sheet. It's okay. Yeah, the free cash flow's come down quite a lot, but that could just be. It's never had a good return on investment, though. Like United Healthcare, I don't, because they willing to bet UNH has double to triple the return on invested capital historically. Yeah, it's double digit, and this one's been 1-2%. I don't think it's a great enough quality business relative to the valuation. I don't like Elevance, so I'm going to pass. I just keep digging in that sector, whether it's Centene has a lot of Medicaid. I'd be like more up the scale, like a Humana, if you don't want the DOJ. I think UNH will probably work really well at some point. Marco Stalterini. By the way, this week we've gotten a ton of inquiries to invest mid-quarter, which we can't accept the $1 million accounts. If they come in materially higher than $1 million, we take them. We do the $1 million accounts once a quarter. But people just saying, I've grew my account to well over $1 million listening to you for the last 3 years, and now I want to give it to you. I mean, it's shocking how many of those emails we've gotten in the last 4 or 5 months. I'm just, that's probably the greatest email I get every day. Marco Staltari. What do you think about European car makers as China sets the stage for an involution? Could they be long-term holds? I'm thinking about Volkswagen, Mercedes, maybe Stellantis. I don't like the producers. I like the arms dealers, not the warring factions. I will never say never, but it's very unlikely I will ever buy a car producer. Nothing new there. I say it pretty much every week. Next. Been a loyal listener for 3 years. Thank you, Ang Wu. Last week, 4 hours long podcast is one of my favorite. Yeehaw! I love that. Yeah, by the way, there was so much good stuff embedded in that. I know a lot of you probably couldn't listen for the full hour, but I'm sorry for you because I gave it all. I left that one all out on the field. I should have done an exit stage left after that one for sure. Thank you for bringing Bracken to the interview this week. Also, thank you for answering my AMA question on OC real estate in the past. So is Brad Jacobs your next guest? Been a big fan of both Brad and Bracken since those TED Talk days. Yeah, no commitments on that front. I am blessed enough. I will be meeting Mr. Jacobs in the month of September with no commitment for any type of podcast, but just an honor to meet with him and hang out for an hour or so and share ideas. So I'm grateful and looking forward to that. There will be no microphone brought with me at that point, but super excited for that. Cole Fleischman, can you share your typical parameters? No, that's for clients. Next, JT Investor. What are your thoughts on Crocs after the recent sell-off? Looks like enterprise value to EBITDA is 5.4 times. Continue to see young kids wearing them, and the Hey Dudes brand seems to be gaining popularity with young men. Would also be curious how Vans is dealing with competition from this brand if you get a chance to ask management. Crocs are big in the swimming community. I would not buy this with your money. I've been getting the same question since up here, literally since $183. Should I buy Crocs? The answer is not for me. Let's see if I have any fundamental basis in that instinctual response. CROX. Why is this not working? It's annoying. There it is. Okay. New simple. At some point, you run out of chefs and swimmers. I mean, who's left with Crocs? What's going on here? Okay, here we go. So revenues have been flat for basically 3 years. 4.1 billion, 3.9 billion. So yeah. So revenue is flat for 3 years. Free cash flow is declining. Margins are kind of holding in. Return on invested capital is collapsing. Let's take a look at the balance sheet. And the price is not really down. I mean, it's down a little bit, but I think this run is over, ladies and gentlemen. I think people have moved on from Crocs. And I wouldn't be caught dead in a pair of Hey Dudes, just saying. No offense if you guys wear them. Total cash. So very leveraged. They've increased the leverage as revenues have stopped going up and cash flow has gone down. They've issued, excuse me, I stand corrected. Their debt has gone down, so they're paying down debt. Let's take a look at, yeah, it's still a good business. Multiples. Look, I'll tell you what. I think your thesis is okay. And I think you might make money as a trade from 80 to 100 back at the top of the range. Maybe you squeak out a double on it. But you really should get some level of confidence that they can reaccelerate revenue growth before you take the plunge, is what I would say. But I generally understand where you're coming from, and it's just not for me. Higher and better uses of capital. I want situations where when I'm wrong, I make a double. And if I'm right, I make multi-bags. Edgard, Abro, keep up the great work. What about Lulu? Looks like the bottom's in. From your lips to God's ears. I can't tell you how many Lulu stores I've been in the last 4 weeks trying to answer this question. And Aloe stores. Look, we got Sun Che, baby. They don't have her anymore. So I can say, I want to believe, but I got a better discretionary play. Like, when you're down, the whole thing is if you can find businesses where your downside's protected and your upside is double, if anything, if it stops getting worse, and it's triple to 5x if things actually get better. That's what I like. I mean, Lulu, if I'm right and everything goes great, I'm lucky to get a double. And for me, that's not worth my time. It's not worth the margin of safety. I mean, let me just see here. Again, similar story to Crocs. Free cash flow is rolling over. And these are not like super. Let's take a look at some of the. This one is a tough one. I keep looking at it. I understand what you're talking about, Edgar. It's just not as good as a VF Corp for me. I'm not saying VF Corp brands are better or anything else. I'm saying my upside is so much higher. So why am I going to commit $1 of capital to this for a double when I could commit $1 of capital for maybe an 8-bagger with Bracken's project, who's just 2 steps up on the turnaround plan, and the growth plan hasn't even begun. I mean, the vast majority of this growth for Lulu is in the rearview mirror unless they really get creative. I mean, Aloe's chipping away. Short answer is, I think you're right. Long answer is, I'm probably going to miss it and be okay with it. Johnny S. sends me a 4-page question. Let's take a look at the company. By the way, if you can't explain your investment thesis with a crayon to a 5-year-old, it's probably not going to work. All right, so they were on a roll. Free cash flow was going up until 20. Why are all these on quarterly? Oh, okay, last 12 months. Okay, great. So decelerated. Revenues were going up. They peaked a couple years ago, 1 year ago. Was this a SPAC or something? Digital promotion services to clients. Consumer packaged goods brands, promotions and consumer network. So this looks like Trade Desk, which has gotten smashed. Technology, publishers to retail, IPN, direct to consumer, blah, blah, blah. I just don't know what the mode is with these. I never even understood Trade Desk. TTD. Getting smoked. I don't invest in these type of businesses because I can't discern the moat. If you're comfortable that no one's going to attack the castle and their moat is strong and what they're doing is special, which is really, really hard case to prove for a $600 million company, then power to you. But let's take a look. Balance sheet is great. Free cash flow is great. Revenues are still growing. There's a lot of issuance of stock. Look at these pigs. They increased the share count from 8.9 million to 24 million in 1 year. So I don't see a commensurate jump in revenues, so it doesn't look like they did a huge deal. So they're pigs. And if they screwed you once, they're going to screw you again. So for that reason, I'm out. No respect of equity. Kirk Holligan. I really like your podcast. It's really refreshing as I get sick of all the talking heads on TV calling for a buy on stocks at all-time highs, but they were nowhere when the stock was cheap. What do you think about Nestle as a buy, and is there any way to avoid Swiss dividend tax? I have no idea about Swiss dividend tax at 35%, but I wouldn't even really care about the dividend on this one if you're going to play it. I've actually never bought a stock for a dividend, so I'll leave it at that. Ask your accountant on that. I'm sure they can figure out something. I mean, it's barely down. I don't know what. I mean, yes, it's a compounder, but like I'd be all over Hershey if I haven't already missed that. Let's see. I think Hershey's a better bet, but let's take a look at Nestle. I don't see anything good happening here. Cash flow is going down, revenues are going down, gross margins are going down. I mean, if you're buying it for a dividend, that's a mistake. I'm going to pass. If you have to have chocolate, buy Hershey. Theo Dujardin. I'm thinking that's a joke and a former hockey player, unless it's the hockey player himself. And I think I know who this is in Canada. Wasn't there a hockey player named Theo Dujardin? Anyway, all right, my Canadians will let me know later. Regarding the Ether machine, would you take immediate exposure through DYNX or wait for the merger to complete and buy shares of ETHM? No idea. I'm not an expert in that. I'm betting on the jockey. If I'm going to bet on crypto, I'm betting on Andrew Keys all day long. Number one. Number two, I have no idea what the price is going to do. What I do see is Tom Lee out saying it's going to 60,000 and all that nonsense. I don't know. Wrong podcast. I would say what Andrew. I mean, if I had to get exposure today, I mean, I had two choices. I could have done the pipe at the time when it de-SPACs, or where I would just be buying, I think, $10 a share at effectively whatever the price of Ethereum is, or the NAV at that point when it de-SPACs, call it fourth quarter or whatever, versus buying now, in which case I would get the benefit or the detriment. Benefit if Ethereum prices are higher 3 months from now, detriment if they're lower. So I chose the private placement, sent in the money early versus later. I don't know. This goes in my can afford to lose 100% bucket. And I think I'm going to make a lot of money in spite of myself on this one because I'm betting on a superior jockey. So I personally, since you're not getting in the pipe anyway, I mean, you're basically making a bet that if you're not buying DYNX now, you're kind of making a bet that Ethereum prices will be lower in 90 days, which could very well be a good bet. I don't know. I'm not an expert in this field. But if you think they're going to be higher, I'd probably be inclined to buy some. I think that ticker is down because right now Tom Lee's getting the flows because they did a reverse merger through an OpCo runoff Bitcoin miner with potential legacy liabilities. We don't know, or I'm not commenting either way. I'm sure they checked it out and they believe that it's clean, and that may very well be true. So that's how they got around that no wait period, whereas the Ether machine had to file and wait 90 days for a clean vehicle where you'll have no potential legacy liabilities going forward, and do it right. And that's what it is. So I prefer that way. And I prefer that jockey. So because I know what he's done in his Dharma capital, and I know that he has an edge over his competition in terms of staking, restaking. It is my view that he has an edge, and I think he will also have an edge in the other things that the vehicle is able to do. That's my opinion. I'm biased. He's a friend, and I believe in him. So if I was not in the private placement, I'd probably, and potentially be 100% wrong, but I'd probably be buying some stock in the market and thinking that it was potentially going to go higher because of now financial institutions adopting it and tokenization on top of that particular blockchain, etc. So again, zero expertise in that area. Zero. I'm sure there are viewers that have a lot more expertise, but I do have really good instincts on betting on the right jockeys, and I have zero doubt on this jockey. Alwyn Lal, Manhattan Associates, MANH. I think this is a software play. I'm not, Buffett never did a lot of the tech or software because their moats constantly got eroded. I lean in that direction. And I lean harder. I mean, here you go. Cash flow is great. Revenue is great. It's leveled off a little bit. It's getting hit with all the software sell-off because there's a lot of AI is going to disrupt in that. Software solutions to manage supply chains, inventory, omnichannel operations, blah, blah, blah. I have no idea what AI is going to do to this type of business. I know exactly what AI is going to do to fluid transfer systems and sealing systems. It's just going to make margins go up. So the financials, I'm sure, are great on this thing, and most software companies, and there's going to be a pony in this pile. I'm just not going to play. I can gamble and win, and I can gamble and lose. I just don't gamble. I bet on sure things, and that's why I have 8 to 12 companies, because there's not a million ideas out there that are sure-ish things. And then there's always what you don't know that you don't know. Otherwise, we would own just one stock. So we own 8 to 10 because you're not going to outperform with more than 15. The math just doesn't support it. Chris Williamson. Tom, love the show. I always share with someone new each week. Try to, at least. If you had to choose one CRK at 15 or Varco at 11, they're two different things. My basis at CRK is so much lower. Varco is just getting started, in my humble opinion. So with new money, we're close to a double already. And, if Comstock got down to like 11 or 12, we would start putting new clients in it, like aggressively. But for our existing book, it's up a lot. So, and it'll double and then double. But Varco, I think, is just getting started in my view, but I like them both. There's nothing I can tell you. I own them both. Jennifer Johnson. I eat sweet green daily. SG looks like it bottomed. I think a lot of the restaurant companies are bottoming. I keep looking at Jack in the Box, even Denny's. These are bad companies, but I'm just saying, I'm noticing what's going on out there. Sweet green, let's see. I'm skeptical of salad shows. Like Kava got smashed. I've seen so many Chopped. I've seen them all come and go. Americans like effing cheeseburgers, okay? They don't like salads. They'll eat salads for a few minutes because they think they're being healthy, but they always go back to the cheeseburgers. So let's see here. How much money do you want to burn? They can't burn money fast enough here. Revenues are slowing and they're still burning cash. I don't know what is exciting about that other than you're looking at the price on the chart. So maybe they Hail Mary it. Maybe they get taken out of their misery and Chipotle buys them or something. But I don't see any real excitement around that. And I think it'll work as a trade. So I think your instincts are right. I just wouldn't. If I'm not willing to buy the whole company, I'm not interested. Deidre Barlow. Thanks. I enjoy your podcast. Listen to it while I walk the dogs. I was wondering what you think about Wendy's. If Nelson Peltz couldn't turn Wendy's around, there's no hope for Wendy's. Okay? He wasted 10 years of his life working on this thing. I don't see it. When's the last time you ate Wendy's? Let me see here. Okay, so revenue's troughed. Call me back if it gets to 6. I'll probably start buying it. I need a huge margin of safety for a business like this. It's going to be fine, but I don't think it's come down enough relative to like the upside relative to the downside. There's no asymmetry for me. So for that reason, I'm out. I think you're probably right, but it's not enough upside for me. Dow Inc. I keep looking at Dow every day. I think you're going to be right, Gareth. My materials play is Albemarle. Okay, I'm putting his name in as the ticker. That's helpful. Dow. I mean, this is the problem. This is why I keep looking at it and doing nothing. They've done something to damage the business. I want to see some light at the end of the tunnel, that revenue stop going down and free cash flow stops being negative. Once you get there, then this thing's going to rocket. So you got to listen to the last 3 or 4 conference calls. What did they say would happen? What has happened? Let's just see, even if you buy it wrong, are you going to live to tell the story? Let's take a look at the balance sheet. Because look, you could buy this thing at 20 and it goes to 5 before it goes to 100. So, which is fine, because if you're damn certain about the business, you're still going to make 5x. But you better make sure that there's no solvency risk here. Let's take a look. So I got $14 billion of debt and $2 billion of cash. It's not ideal. And negative free cash flow. And declining revenues. And they're confident enough that they're buying in stock while all this is happening. I think you're right. I'm not going to participate. Eric Klein. I love the podcast. At what level is Lilly a buy? Ladies and gentlemen, go look and check the records. In November, what was it, August, on Yahoo, when the thing was at all-time highs, and they made me do that segment, which I hate to do because they like goodbye good B-U-Y or goodbye B-Y-E, and you have to do a long stock in the sector and you have to do a short stock in the sector. And people were euphoric about Lilly because they had this miracle drug that was going to change the world. And I said, it is a miracle, and here comes competition, ladies and gentlemen. And the stock has gone nothing but lower ever since. And by the way, the same thing is going to happen with all these AI names and GPU, which will become a commodity producers. The next phase of AI play will be the companies implementing it and doubling their margins. It will not be the providers because the CapEx is too severe. They will do. So this Lilly, drugs, productivity, all the stories, go back to it. What about Novo Nordisk? Was going to be bigger than the entire European stock exchange. Straight effing down from 66% drop. Are people still losing weight like crazy and getting healthy from Novo Nordisk and Lilly's life-changing drugs? Yes. But now you've got competitors and competition. When you have abnormal margins, you invite competition, and both Lilly, Novo Nordisk, etc., have done that. It will be the same thing with the AI producers and providers that people are tripping over themselves. And but right now we are not in the distribution phase like we are with Lilly and Novo Nordisk. We are in the euphoria stage, and people are buying it while insiders are dumping hundreds of millions on their head, and people think it makes sense. So for now, so the answer is you couldn't give me. I wouldn't buy this. I mean, this would have to get down, and it's not going to. This would have to get down to 150 before I even took a first look, and it's not going to. So, so that's that. Lily, okay. Aaron. A little off topic. I have a 5 and 6 year old. You and your wife do such an amazing job with your girls. Future Olympians ain't too bad. What's your secret philosophy? Life parenting books. Your wisdom is admirable. I think part genes, part luck, and mostly lead by example. I think that's the key in anything you do. Anything you want other people to do, you got to do it first. And that's that. You know, no one's perfect, but lead by example. David Simona. Hey, Tom, I've been following you since I saw you on TikTok. Started buying Alibaba, got my basis down to $82. So thank you for that. I also have CPS, PayPal, just an inquiry on selling. I don't want to exit too early or late. Will you be letting your listeners know when you think time is to move on these companies? No, at all. Historically, number one, this is to teach you a general framework like Ben Graham taught to Warren Buffett. Okay? It's your responsibility to do your own work on any investments. Number one. Number two, unless you hire me as your manager, then it's my responsibility to do that work for you. However, over the last 5 years, when we have exited a position, we have let people know, like the Vernados, like the Range Resources, like the Wells Fargos, like on and on and on. So there's a good chance that we will continue to do in the future what we've done in the past, but that there are no guarantees. If you do not understand why you bought it and what it's worth, you shouldn't be in it. You should just sit back and learn and not put any money at risk until you learn better over time. But to that point, we generally do let people know when we have fully exited a position. Hunter. Big fan. Thanks for making me money. You're welcome. Thank you for tuning in. What's one thing you'd recommend a junior in college do to make themselves stand out? Hunter. I go to an SEC school, so it's kind of hard to stand out to the big banks like Goldman or JPM since I don't go to the best academic school. I wish I knew this before going to college. Also wish I knew okay, so end phase we've done a million times. We did a interview with the University of Bristol Investing Club. So just go to YouTube under Hedge Fund Tips, search Bristol, Bristol. I tell you step by step everything you should do if you want to get into this industry. And then end phase, we'll do one more time. I do think this group has gotten oversold dramatically. End phase is not one. Everything looks right about it. Instinctually, I just don't want to be involved in it. I think there's just so much. Believe it or not, green tech did well under Trump, did poorly under Biden. Energy did well under Biden, did poorly under Trump. The exact opposite what everyone would expect. So there is a huge pony in the pile of solar I think it's going to work. I'm not going to participate unless it was like First Solar came down to levels where I got super excited. That would probably be the only one, because I think the Walton family still owns most of it. And I probably missed that opportunity in April, but it's not, that's when God gave out FOMO genes, he didn't give any to me. Like, I'm happy that everyone else makes money in solar. I'm probably not going to play there. Lucas, thank you for the value you give each week. You're welcome. One of the highlights of my week. Quick question. Are there any stocks you passed on that you regret passing on? Zero. Absolutely none. I don't have any FOMO. I just make sure errors of omission are not, I don't even think about. Errors of commission, where I made a investment decision, I put capital at stake. If that doesn't work, then it's on me. Omission, I could care less. Don't even think about it. Wilhelm was just in a Timberland store in Aveiro, Portugal. The store was completely full. Best customer service I experienced in a while. And I was trying on slippers. Opinion. Gersheimer. He wants me to look at RRESHEIMER. Revenue's growing, margins are collapsing, free cash flow is negative. That's a pass for me. It's a new client inquiry. Lachlan, longtime listener here. Want to ask if you personally began your career on the sell side? No. Do you believe it's necessary to start there? No. As opposed to joining a fund or family office under someone you admire after graduation or working a few years in a different industry. If you have an opportunity to work under someone you admire, you should do that if the opportunity is available. The benefit of the big banks is that you get a massive training program, and the really good 1 or 2 man shops aren't going to have time to train you. Ajit Alkandon, thoughts on Duolingo? I think it's great, except for the fact that AI is going to destroy this model. I think this is, my kid uses it, loves it, and it's the best in game now. But you could probably, if you knew anything about AI, go on Grok and have them create a program to teach you the same thing for free. So I think they're going to struggle a little bit, and maybe this is an overshot on the negativity, but I don't want to take that bet. So for that reason, I'm a pass. Tom, planning to pursue a CFA in a year or so. What resources should I be turning to in the meantime? The CFA books. And start now. Why would you wait 2 years? That makes 0 sense. Lee Foster, could you take a look at Unite Group UTG? It's a UK REIT, and I've said over and over, if I don't know the buildings, I'm not doing a REIT. So we did Vornado because I know all the buildings. This, I don't see anything that's exciting to me. This looks like it's going to be a debt problem, but for that, this is like asking me about what the price of Bitcoin is going to be next week. I have no idea. I think we're done. Wow, a lot of great AMA questions today. Another guy. Okay. Well, with that said, we will be back next week, same time, same place. In the meantime, make it a great one. Bye for now.